Good day guys, welcome back. In this video we are going to talk about another ETF, famous ETF called ARK Innovation ETF. It has a ticker code ARKK with its Chief Investment Officer Cathie Wood, the celebrity fund manager that has been able to outperform S&P 500 and even Nasdaq 100 index. You can see that the 5-year average return for ARK was above 40% per year. If you compare with IVV from S&P 500, they only have done 16%. And NDQ from Nasdaq 100, they only have done 24% for the past 5 years. Is this a brilliant investment opportunity or a bubble? ARK ETF has a net asset about 22 billion US dollars. And when I see 41% per year increase, interestingly, Nasdaq 100 index around the dot-com bubble from 1995 to 2000 experienced a similar dramatic increase, about 58% per year in that 5 years. But over 25 years, over a long term, the return goes to about 13% per year. It does make you wonder, is investing in ARK similar to investing in a bubble? And there's so many videos, articles been written around ARK and Cathie Wood. There are people talking about the danger. They are talking about the buyer beware and the collapse of ARK ETF, and people, why am I buying? And you can even build your own ARK portfolio. This is amazing. Cathie Wood is famous for making bold predictions such as Tesla and Bitcoin, and even her prediction with Tesla has been fulfilled, so that's why she is really famous for the year 2020. In December 2020, she's aiming for $3,000 per share for Tesla, given with the average number of ordinary shares, about 930 million shares for Tesla. Cathie Wood is aiming for market capitalization for Tesla to reach close to 2.8 trillion US dollars in 5 years. I'd like to thank Blake Riley and also Shaikul Yasmin for recommending us to look into this ETF. Cathie's valuation for Tesla for $2.8 trillion is not something to be taken lightly. If you think about Apple that has a market cap just under $2.5 trillion and be able to generate revenue over 50 billion US dollars, that means Tesla will need to generate that kind of revenue above $60 billion. And that, I believe, is not an easy task to do within 5 years. Because if you think about Amazon with a market cap over $1.6 trillion and generating a profit of $20 billion just in 2020. And then if you think about Facebook or Meta recently, Facebook generates an earnings about $18 billion and a market cap that is quite similar with Tesla, close to $1 trillion. And based off recent filings for the earnings for 2020, Tesla is able to generate close to $700 million. That is really great that Tesla can generate money from now, but the path to $2.8 trillion within 5 years is not going to be an easy one. Because if you think about Toyota, the second most valuable automobile manufacturer that is generating an earning around 20 billion US dollars a year, has only a market cap about $240 billion. So in this video, I'm just gonna share with you my opinion about ARK ETF. First, is the disruptive innovation follows the dramatic decrease of cost curve. What I'm talking about, will it decrease the cost of revenue of any companies that ARK Investment holding? And lastly, we're gonna have a look at the past performance of Cathie Wood and also one of the directors, Brad Winton, who happens to be an ex-co-worker in AllianceBernstein. Because Cathie Wood has been managing money for years, and why we only heard about her performance from ARK Innovation for the past 7 years. Why we never heard about the ones prior to that in dot-com bubble or prime mortgage crisis. So without further ado, let's get into it. So with ARK Investment, I think most of you already researched heavily with this ETF. Cathie Wood admits that ARK Investment is a volatile strategy. It's not to be taken lightly, and they mention it up front. But most people overlook this and just look at the past performance. Oh, they have done 40% and they're going to do 40% in the next 5 years again, and we're going to be rich. I think that is a mistake that if you view this ETF that way, because ARK Investment has done what they are required to do. They mention all the risks such as uncertainty, unknowns, competitive landscape, patent and intellectual property rights. But in my opinion, the market generally see ARK investment as a lottery ticket to be rich in a very short amount of time. But let's have a look at this in a rational way. Cathie Wood always mention these three things in her presentation. She always mention about disruptive innovation. And the first thing that she always mentioned about Wright's law, and to be quite honest, if you listen to most of her presentation, it's filled with fancy words. And most of the time, it doesn't help you understand the business at all. So we're gonna have a look at deeper about what she meant by Wright's law and how it'll do a saddle and the tipping point, the cost curve bends, and more innovation will create disruption, and cost curve declines will create more profitable business. If you look at ARK investment, what they meant with the Wright's law, they studied heavily with decreasing costs of manufacturing of batteries. Lithium-ion batteries, of course, that in their opinion, will impact greatly in the cost of electric vehicle manufacturing. Because as we know, as of this day, cheapest electrical vehicle is about twice the price of the internal combustion engine. Say, if you pay $30,000 for Toyota Camry, you have to pay twice of that to get a Tesla in the similar level. But if you think about the cost of manufacturing battery is just one aspect of auto manufacturing business. To be honest, if you look deeper, I'm not an expert in automobile manufacturing. If you look deeper and listen to what other manufacturing say, automobile manufacturing is a cutthroat business. And they rely in hundreds of different parts suppliers for many companies. And at the stage we are now in the late 2021, we are in the global chips shortage. That will cause a problem too. That will increase costs, obviously, because it's going to be more expensive to get a request to make sure you get the chips that you need to build your car. And the decreasing cost, it involves manufacture. Obviously, you gotta get cheap labor somewhere. Obviously, you're gonna have to build your car in China. And you're gonna have cheap lithium from where? From Australia or maybe Indonesia. And you gotta find the optimum processing technology for lithium. So if you just looking at Wright's law and Wright's law is going to make us rich, you're making a big mistake there. If you look at the Tesla 10K for their annual filing to SEC, you're going to have a look at the cost of revenue. So we have consolidated statement of operations. Tesla in 2020 generated a total revenue of $31.5 billion US. It is an increasing trend from 2018 of $21 billion. And if you look at the section underneath it, the cost of revenues, the automotive sales and automotive leasing, energy generation and storage, the total cost of revenue is $24.9 billion. What I'm trying to say is, if our investment presentation about Wright's law is correct, that means the cost of revenue will drop significantly as the revenue increase. But that's not the case, because if you find out the percentage of the cost of revenue, that is the total cost of revenue of $24.9 billion divided by $31.5 billion, you get a ratio of 79%. And if you do that for the rest of the years, it is the same. The previous year is about 82 and it's never gone down below 79%. And if you do that for another companies such as Toyota and BYD, yes, Toyota have slightly higher cost of revenue, but on average, they're all underneath 85%. None of them has a dramatic increase cost of revenue suddenly to 60 or even 50%. If you go deeper and compare the return on equity, that is the earnings divided by the net asset, Tesla return on equity hasn't been that great. And that's okay, because they're still building a lot of factories all over the world, in Germany, China, and so on. So we still have not seen them giving a really high return on equity. So we cannot really compare straight up like how Toyota has given up a consistent return on equity above 10% for the past 4 years. And if you look at the Tesla competitors, the China version of Tesla, that is BYD. BYD, 50% of their revenue is obtained from selling batteries, lithium batteries, to electronic gadgets such as your smartphones, Apple's. And BYD's return on equity has has been close to 10%. If you compare to Tesla for 2020 of just 2-3%, obviously BYD is better. I'm not trying to influence you to buy or even sell Tesla. What I'm trying to say is that just looking at one specific idea, fake idea of just Wright's law, and that will intrigue you to purchase this ETF, I think that's a mistake. You gotta learn a bit more about how these fund managers sees Tesla. Because let's face it, Tesla is one of the most expensive electric cars out there, and I believe it will remain that way for a long time, because Tesla started with Elon Musk's ideas to make super sports car sexy, but it's electric and it needs to be expensive, because otherwise the rich people wouldn't want to purchase Tesla because they think, oh, it's just cheap electrical stuff. Interestingly, if you look at the BYD stock performance for the past 1 year, they receive a similar optimism with Tesla, because Tesla has increased by about 178% and BYD has increased by 85%. And yet the earnings hasn't been grown by not much. What I'm saying is, if you are willing to invest in ARK investment, never feel smarter when the stock price goes up, because you will feel more stupid or dumber when the price go down. This is a quote from Jeff Bezos. And also think about the return depends on the price you paid. Because my concern is that people who are purchasing ARK or copying ARK portfolio is that they stop learning about the business itself and fell into fear of missing out hype. And they end up following crowd decisions, and therefore becomes the reason why ARK Investment ETF is a volatile ETF. When I look at the recent annual reports from ARK ETF, Cathie mentioned about Teladoc. Teladoc is a telemedicine company, and what surprised me is that she said about, despite reporting a strong fiscal year, share of Teladoc detracted in the face of competitive noise. So she really paid attention on the share price fluctuation of that year, instead of looking at what's happening with Teladoc. What is the competitive advantage of Teladoc? And that's exactly what I did. I just look at briefly. So this is Teladoc financials from Nasdaq.com. The operating income for the past 4 years has been negative. They've been reporting a net loss, 75 million in 2017, and 2020, 500 million. So even though the revenue increased from 230 million to $1 billion in a matter of 4 years, the cost of revenue and also the cost of marketing becoming bigger and bigger. And obviously when you see of that, that's not a profitable business. And Teladoc is the second biggest holding for ARK ETF, and it doesn't follow Wright's law. Maybe it'll be realized within 5 years, because Cathie always mentioned about 5-year investment time frame with 15% per year potential return. But like I said before, not all big data and artificial intelligence is just one aspect of the business. If you have great technology but your management suck, like if you have Amazon but you don't have Jeff Bezos, or you own Facebook but you don't have Mark Zuckerberg, I don't think those companies will be as profitable as they can be right now. And if you calculate the cost of revenue of Teladoc from 2017 to 2020, it has increased from 26% and 35%. And I'm not an expert in American health system, but I heard there's a lot of improvements to be made because the citizens are paying too much. And they always look at Australia and Canada, how they have way better healthcare system. So I think there is more than just technology problem in the US healthcare industries. And again, if you look at the share price of Teladoc, it's very volatile. From February to October, it has lost about 50% of its value. So imagine if you're buying in February and losing 50% of your money. How would you feel about that? Are you prepared for that? And if your argument against that is that, oh, Cathie has done 40% for the past 4 years, I believe that's not good enough, because history doesn't repeat itself. Next, Cathie always dodge the question when people talking about, oh, what are the multiples? What are the how many cars that Tesla need to sell? She always reply to them, oh, that's the traditional metrics. And ARK investment are looking at it in a different point of view, such as robotics, autonomous vehicles, machine learning, energy storage, blockchain technology, and they don't care about market cap, style boxes, industries, and sectors. The way I see that, she dodged it for a reason too. After listening to a lot of ARK presentations, ARK has really strong marketing strategy. Their marketing is great. For people who want to get rich quick, ARK sounds amazing. Let's get back to Cathie's prediction to $3,000 per share for Tesla, or market capitalization of $2.8 trillion by 2026. That is a bold prediction. I'm not saying it's impossible, because we are in the low interest era. Anything is possible. Because Tesla for 2020, they've sold about 500,000 cars, and in order to reach 60 billion earnings, my calculation is that they need to sell 20 million cars, or that means 35% market share needs to be owned by Tesla by 2026. That is not an easy task. Can Tesla beat Toyota that has sold 9 million cars in 2020? I don't see why not, but it's gonna be difficult. Because if you look at Amazon, how they reach over $1 trillion market capitalization, Amazon went public around 97 or 98, and they reported a net loss for the first 7 years till about 2002. In 2003, they start making money, 35 million, and then they reported a loss again in 2012. And guess what? People who are investing in Amazon for the past 20 years, they still make a decent return, above 25% per year. And that's why I get it that price to earning ratio is not enough in valuing companies like this. The fact is, Amazon has done a lot of disruptive innovation too. They are one of the companies that reduce the artificial intelligence cost as well. And since 2015, Amazon net earnings has increased by a lot. Say in 2015, they earned $600 million. And within 5 years, they earned $21 billion. That is a dramatic increase. And if you think about American corporate, anyone who invests in American corporate through S&P 500 or NASDAQ 100 ETF, index ETF, you're already investing in disruptive innovation. There's something in this S&P 500 and NASDAQ 100 that produced Google, that produced the first touchscreen iPhone through Apple, the first profitable social media company through Facebook. There is something in America that works. And I believe just rebranding them to be disruptive innovation and giving a hype to everyone that they can get rich quick, I think that is a mistake. And if your feeling is based on the share price level, that is the worst state you want to be, because when the price go down, you're gonna feel a lot worse. Now, for the last section, let's have a look at the history with Cathie Wood and Brett Winton, the director of research. Both of them used to work for AllianceBernstein, another fund management company. But what interests me is that Cathie Wood has been around for a long time. She's born in 1955, and she started as an economist from the age of 22 to 33, and then by the age of 43 in 1998, she founded Tupelo Capital Management with Lulu C. Wong. And it's a hedge fund that I never heard of with the track of performance. I tried to research it and never heard of anything. Maybe it's very high end. And then she is a chief investment officer for the global thematic strategies for AllianceBernstein from 2001 to 2013, and they're managing about $5 billion. And she quit AllianceBernstein because they refused to follow her idea of disruptive innovation. That is what ARK Investment ETF right now, in 2014. But if you look at what happens in AllianceBernstein in the Sustainable Global Thematic Fund, I may be wrong in this, but I have a strong conviction that the reason why we never heard Cathie's performance from Tupelo and also AllianceBernstein, because her performance is poor. Her performance is great in the bull run, such as dot-com bubble or even near the subprime mortgage crisis. But when the reversion to the mean comes, the reality kicks in, she cannot perform long term. And she even said to the investor that it's okay to sell some of your stock. But she can't say that fully because she knows that the profitability of these companies are not there yet. the valuation is overpriced. And that is a skill that you need to have throughout your investing career, is that you gotta be able to sense whether things are overvalued, things are too expensive. And if we look at Alliance Bernstein Sustainable Global Thematic Fund performance from 2001 to 2013, it gives out really poor performance. I may be wrong in this, like maybe Cathie was not aware, but that's what she said. She was a chief investment officer for Global Thematic Fund from 2001 2013, but 27% over 12 years is really poor gain. That's about 2%, and if you account for inflation, you actually getting a negative return. But if you look at the replacement for the chief investment officer, the story kind of fits in because this guy Daniel fills in 2013, just in time where Cathie left. And I may be wrong with this, but what I'm saying is that there are very few great fund managers that have track record over 20 years of consistent return. Because realistically, corporate earnings over a long term will give you average 5%. This is just being realistic here. You got to remember too that making great gains in the short term in the market is easier than capital preservation for the next 20-30 years. Blake and Shiloh, I believe your learning curve with ARK will explode exponentially once you bought it. It will be innovatively disruptive. It will be part of the multi-trillion-dollar opportunity. It will take out all of kind of competition. Do you see? Do you see me using those big words? My opinion is that disruptive innovation is only one aspect of the business. US corporate is filled with many innovation. That's why America is where they are at right now. That's what makes New York Stock Exchange famous, because they attract amazing innovation. Think about Amazon, how they reach over $1 trillion valuation. And obviously Wright's law, it's a great marketing tool in my opinion. But my worry is that if you purchase this ETF, please never stop learning about the business, because I myself, I never stop learning. I'm a continuous learner and I make mistakes along the way too. But your mistakes shouldn't be so severe that you will lose 90% just because you get it into the fear of missing out mentality. And like I said, for any kinds of thematic ETF, is enjoy it while it lasts. Our stand in OzFinanceTV is still the same to the usefulness of S&P 500 and NASDAQ Index ETF. Over a long term, it will give you exposure to the innovation of US corporate such as Apple and Facebook, even Netflix, without the risk of wild volatility. And lastly, lack of information for Cathie Wood's and Brett Winston track performance prior to ARK investment is concerning. Why are they not showing their return during the dot-com bubble and the subprime mortgage crisis? Is it that bad? And my suggestion is to read out Howard Marks' memos. He's a billionaire and he reached his billionaire status by calculating risk, by being rational with his decision. And that's how he can achieve over 20% return over 20 years period.